We are live on Facebook for the Thursday edition of the Not Your Average Investor Show, Rental Income Property of the Week.
Week.
I'm your host, Pablo Gonzalez. With me, as always, the man they call GC because he's the golden child of rental properties and because his name is Gregg Cohen.
Hey, Pablo, golden child. Only my little sister calls me the golden child, right? When we were growing up, right? Great to be with you all here. Pablo, that was an incredible introduction, my friend. You bring your A game every week, and I still get the biggest kick out of it.
You do, Greg. I'm glad that you're my number one fan, quite frankly, because otherwise I feel real lonely out here. Happy to have everybody here in the chat, here with us today. As you know, this show is about you, particularly this Thursday show, right? When we're going to break down the numbers of a property and really just get into the nuts and bolts of any questions you have, anything that we can answer you. So we want you participating. And there's two ways to participate. The first one is the chat, which is already blowing up. I love seeing it. Now, there's a little trick to the chat, and we love seeing everybody's comments. But when you first go in there and you're typing in, it's defaulted to only show Greg what you're saying. It just says panelists in that blue box. If you hit the drop-down menu and you go to panelists and attendees, now everybody's talking to each other. So Lou Carlson from Somers, Connecticut, you're new, welcome. Lee Bishop, you know what you're doing. Lou, you're only chatting to us right now, right? Carol Moaning from California, I believe. She's back. Invested in Illinois, but looking to invest with JWB. You're only talking to us as well, but we want you talking to everybody else. Peter from the Dirty Jersey. He is talking to everybody, right? So like now we see the difference. Helen Kennedy, brand new from Fort Lauderdale. Helen, welcome. I am, as you can probably tell by my name, I am a Miami guy. So I'm very familiar with Fort Lauderdale and South Florida. And I'm really familiar with the pain points of how much properties cost over there and how hard it is to invest in rental income properties when you're in South Florida versus now that I live in Jacksonville, this cornucopia of wealth creation that's ready to go for you. And I'm getting beside myself. The other way to engage in the chat, to engage with us, is the questions and answers, right? If you want me to ask Greg a question live on the show that he will answer for everybody else, that will probably make it to our content stream of the Not Your Average Investor Show stuff, go to the Q&A part because that stays there. What you'll see, the chat is kind of like moving up and down. If you have a question you want to ask on the show, if you put in the Q&A, it saves it there until I click it and I know that I asked Greg the question. So do me a favor. I may go cross-eyed if I got to keep track of everything else, but I'm going to do my best for anybody that didn't hear this, and I'm going to continue to coach you through it. And last but not least is the idea that we want you taking the next step after here. And if you're new, maybe the next step is to go to JWB web class and download the free investor package and watch Greg explain all the benefits of rental income properties and the three things that you really got to nail in order to really succeed in this asset class. That's jwbwebclass.com. And if you've been around the block a couple times or you really like what Greg is saying, which I generally do, and I have done, is go to chatwithjwb.com and set up an appointment, get on with a team. We'll do a custom package for you. We're here to answer questions for you, anything that you need. Without further ado, that was a mouthful. I kind of got, I feel like we started late. So I had all this like pent up energy that I had to get out, Greg.
Anytime you throw cornucopia in there, it was well done.
I'm not sure if I used that correctly. So put that in the chat. Did I use cornucopia correctly?
How do you spell cornucopia too?
That I can spell.
Oh yeah.
Well, we're
going to make this more difficult then. I'm going to find words you can't spell.
Welcome to the Hunger Games. All right. So Greg, are you ready to dive into 8906 4th Avenue? First of all, tell us about, this is a property that is only $135,000. So who was it that was that's from South Florida? Good luck finding a property for $135,000 in South Florida. Less than 15 minutes from over 80,000 jobs is how we are teasing this thing, Greg. So tell me why that is. Let's start with the neighborhood while I pull this up. What are these 80,000 jobs that you're talking about? First of all, why is it important that it is close to 80,000 jobs?
Well, the key to investing in rental properties is, number one, you need to find positive cash flow. You need to be in a market that grows over time, right? You need to be with a team that can make sure that we turn these estimated returns of investment into real dollars in your bank account and real growth over time, right? Those are Those are really key. Well, the reason that we need to be able to get positive cash flow, and the way to get positive cash flow, is to invest in the right neighborhood. The right neighborhood has low prices, high rents, and is surrounded by jobs. Surrounded by jobs is really important because nothing really works in this model unless you have a great selection of residents who want to stay in your home for a very long time. And when there's significant job base surrounding your neighborhood, you're going to greatly increase your chances of success here. So I don't know about you, but 80,000 jobs within a 15-minute drive, that's a lot of jobs, right? That's one of the reasons Jacksonville is a haven for investors, right? That's why they love coming to Jacksonville for single family rental properties. It's because we have such incredible job bases here, whether that's the military, right? Whether that's shipping and logistics, whether that's financial, whether that's the healthcare system. We are stacked with jobs. And so I haven't pointed all that out so much in the past shows. We talk in generalities, but when you put the numbers to this, there's over 80,000 jobs within a 15-minute drive that serves the North Side neighborhood, which is where this home on 4th is located. So
that's right. So Greg, so I put, first of all, I just want to say anecdotally, moving here from a bigger market, right? I moved here from Miami about 2.5 years ago. I thought that the economic opportunity of Jacksonville, I thought that I was giving a trade-off between kind of cost of living and quality of life and economic opportunity. I was way off, right? like the amount of opportunity, economic opportunity that's happening here, I think at every socioeconomic level is pretty outstanding, right? But specifically for the asset class that we look for here, that you look for at JWB, Greg, that is for the kind of like that C neighborhood, blue collar kind of jobs, right? In this neighborhood here that you call the North Side, right? So when we say the North Side, we're talking about here's downtown. This is the North. Right.
There you go.
So like, I guess it's surrounded by this 295 loop, but really more specifically, we're talking about right around here, right? Like this kind of pocket is where all your homes are.
Yeah. If you see just slightly north of that market right there on 4th Avenue, that's called the Trout River. So we're surrounding the Trout River for the North Side activity. You're slightly above. As you go farther and farther north, you get closer to the airport. Your home prices become a little bit too high to get positive cash flow. And then we're surrounding it on, south of the Trout River as well. That's our pocket where you have low prices, high rents, and are surrounded by jobs.
Got it. And the big job drivers in this area, we mentioned. Well, did you mention them already? I feel like I've just been on like.
No, we didn't specifically say how we got to 80,000 jobs. So let's kind of identify that. Do you want to point out where downtown Jacksonville is for those folks?
Downtown Jacksonville is right here where it says Jacksonville, and it's surrounded by all my favorite coffee shops that have been highlighted here in Google Maps.
There we go. Got lots of hearts on the map. That's really good.
I love coffee.
So that is the biggest central location of jobs in Jacksonville. We have over 55,000 jobs in downtown Jacksonville. And for our residents that live in the North Side, right, you can see I-95, right? Everybody knows I-95 if you're anywhere along the eastern seaboard of the United States right now, because I-95 goes all the way up to, past New York and all that good stuff, and all the way down to Miami, right? So 95 is a major interstate. You literally jump on 95 and you're there in less than 15 minutes. And so you have 55,000 jobs there. We're anchored by 3 Fortune 500 companies that are headquartered here, right in downtown Jacksonville as well. So that is our central job base. But that's not the only significant driver of jobs. One that we're going to be talking a lot more about, especially in future episodes, is the port of Jacksonville. Jacksport is what it's known as. And 26,000 jobs come from the activities from Jacksport that serve just Jacksonville. And I was actually looking up the number of jobs beyond Jacksonville that Jacksport supports. And I want to make sure I get this number right, because it blew my mind as I was looking at some of these stats here. So let me just make sure I've got it here. It was boom, boom, boom. There we go. The anticipation is mounting. 138,500 jobs in the state of Florida from Jacksport. Over $31 billion in annual economic output for the region and the state from Jacksport, right? This is an incredibly large economic driver for not just Jacksonville, but our state and our region. And the coolest thing is that the average salary for a Jacksport job is $70,570.
That's pretty
Which is
cool.
incredible.
Yeah, that's cool. But by the way, that $75,000 number is kind of like economists say that like after you make more than $75,000, that's when like making more money, the marginal benefit of making more money is less than the marginal like.
Is that it? I thought that it was 50,000.
No, it's
Is
75.
75?
So, yeah, 75 is that crosshair where it's like you go from worrying about day-to-day stuff to you start being able to play a little bit of offense, right?
There you go.
That's the best way I can put it.
And that's fantastic. What you're definitely going to be able to afford is rent.
yeah, for sure. And listen, I got other numbers for you, man. While we're on that numbers kick, because spoiler alert, we got Eric Green, the CEO of Jacksport, coming on the show in January, is it?
I think so. I think it's early January. How cool is that we have the CEO of Jacksport going to spend some time with all of us here on the show?
So I've been spending a little bit of time with his director of communications. She gave me a couple little nuggets to add here. Jacksport is the nation's second busiest vehicle handling port. It's Florida's largest container port. It is a major driver for e-commerce to the entire southeastern region, right? So like we talk about big drivers of economy, e-commerce is a big one that's rapidly growing. It's been growing through COVID. And yeah, those are the best. Oh, and it does 90% of goods that come in and out of Puerto Rico to the mainland of the United States pass through Jacksport. So a couple of interesting things.
That's pretty good. I got one more for you.
Go for it.
94 million customers can be reached through same-day service through the port and then our distribution network here in Jacksonville. And the port obviously is a large part of that. So we can just have dueling facts back and forth.
I have been challenged to a duel.
But the big thing here is, right, this is one of the huge drivers, right? This drives our north side neighborhood because we have the 3 terminals that are very close to the north side neighborhood. This is also one of the economic drivers for the Arlington neighborhood as well. This is a driver for all of Jacksonville and a huge economic or a reason for our economic stability and future economic gains as we continue to make bigger and bigger investments in the port.
And Greg, this is not your average economic development show, right? So like I kind of want to frame this as what this means is that this property that we're about to show is very, very well insulated with demand of people that are going to want to live in this area to have access to these jobs. Am I right?
Absolutely.
Yeah. So let's get to it, man. Let's show the darling property that we're talking about here. So this is 8906 4th Avenue, Jacksonville, Florida. Again, we showed you the neighborhood where it was at. And just so you know, if you're new to this call, we repurpose this stuff into podcast. We have a friend that's listening to us right now in the future inside their ear that doesn't get access to this picture. So I'm going to talk through it a little bit. The purchase price of this home, $135,000. It's a 3-bedroom, 2-bathroom house with a driveway, estimated rent range of $999 to $1,049, leased for 2 to 3 years. And here is the important, I'll describe it a little bit, right? Like single-story home here, pretty little house, man. This looks nice. Is this a rehab or is this new construction, Greg?
This is a rehab, a renovated home.
Wow, this is really nicely renovated, man. I would have thought it was new construction. And again, what you're actually buying when you are buying into JWB, you're not, I mean, yes, a home comes with it, but what you're buying is this stuff right here. It's this estimated conventional financing, total monthly cash flow of $231 per month, and an estimated total ROI of 10.09%. Greg, we like to, for people that are new here with us, talk us through what is this monthly cash flow number represent of $231?
Yes, this number is what you should think about hitting your bank account as a net amount every single month during normal months of owning this rental property, right? A normal month would be when the rent comes in and you don't have some of the external, both positives and negatives that happen, right? So what I mean specifically is your rental income comes in, you take away your principal, your interest, your property taxes, and your property insurance payments, as well as your property management fees. You take all that away, and what's left over on a normal month is roughly $231 for this home right here. What this does not include is those things that happen either external to your bank account or don't always happen, right? What it does not include is it does not include your maintenance cost, does not include your vacancy cost, your vacancy expectations. It also does not include your estimated tax savings for investing in rental properties as an asset class. It does not include your principal pay down, which is what your resident is actually paying down for you. They're paying down your loan for you, which these are all profit centers. Of course, also it does not include home price appreciation. But this is just what you should feel like on a normal month, with the vast majority of months are going to be normal for you when you own a JWB rental property. This is what you're going to net.
Quick question here from Jeff Spiker in the chat. What's this little hill we got on top? Is this like the highest point in Florida here? Is there a potential, like, are you guys putting in features for landscaping, or is this going to be de facto some kind of like natural elevation bump that's happening in Florida?
No, so we actually own the lot next door and are building a new construction house next door. And so this, and when you build new construction, one of the things we'll talk about is this is on septic in this home. So you have to have a drain field, right? In the state of Florida, drain fields come up above ground. And so this drain field is for the new construction home that is next door. Now, the most important thing is to make sure that this drain field does not affect your maintenance costs, right? That you don't have shared liability here. That is not the case. Either the property, the lot has been separated, or there's an easement on it. I was actually just checking before the show. I didn't know 100%, but I know 100% that that person's drain field is not going to wind up on your maintenance costs, which would be the only concern that you would have. But no, there's going to be another home built next door, which will actually be brand new construction. So that's the drain field there.
Talk me through, before we get into the ROI and appreciation, Greg, talk me through this. So why would I want to buy an investment rental property when I've got someone else's drain field? Isn't that is someone else's drain field encroach, like being at the entrance, is that going to affect me as somebody that's investing in a rental property? Like, should I be caring about whatever kind of aesthetics this is producing here?
Well, it's truly an aesthetic issue. So if you're investing based on aesthetics, then you should not invest in this house. Right?
Why is that? Why is that?
Well, I'm just saying, like, aesthetically, it doesn't look that great, right?
Mm-hmm. Okay.
I mean, that's just the reality, right?
Yeah, I thought you were saying something different. That was
No, I mean, ideally, would you not like to have the drain field there, right?
Yeah, sure.
No, right? Yeah. But aesthetically is really the only difference here. Now, we talk a lot about how to invest in rental properties, and a lot of times we're talking about how to turn that aesthetic, right, that subjective, that emotional part of your brain, and really turn that off, because your job here is to produce the best risk-adjusted return on investment, right? And your job is to create the best living environment for your resident at the right rent so that they're going to stay in your home for a long time. Now, the reality is that drain fields like this, being close to properties, is extremely normal in Jacksonville, extremely normal in Florida, right? There are a lot of properties that have something similar to this. Would you like to not have that so close in an ideal scenario? Yeah, probably. But is it going to affect your return on investment? No. The one way that you should be careful about not investing in something like this is if there was some sort of shared liability, where if the drain field, if there was an issue on the drain field, somehow you would have to work that out with the owner next door, to figure out whose problem it was. And that's something that could really be a problem. That would be the only reason to not invest in something like this, would be if it affected and potentially created a terrible situation as far as maintenance costs. But that's absolutely not the case for this one. And so as long as you can invest in an objective manner, look at this as being a better renting opportunity for your resident than what else is out there because of all of the features of the home, and realize that this is a very small, minor, inconsequential part of their renting decision, then you're going to make a better overall return on investment decision.
That makes sense. So if I'm taking a job at the port, I'm taking a job at the Amazon fulfillment facility, and I'm thinking, man, I really need a house to rent and I don't want to drive very far from work because I want to be close to my kids or whatever.
Mhm.
The idea that having this little bump out in front of your house that you got to like walk past if you come out of your porch really is like tertiary, fifth, 20th decision making after how and what good of a condition the house like what like what are the other things that they're thinking as a
Well, yeah. I mean, first let's look at the rent, right?
let's
Let's
look at the
let's
rent.
look at the rent. Is the rent affordable for this person? Absolutely, right? $1,024 is the rent on this one. Should also point out that I can tell you how inconsequential it is because not only do we have a resident who is in this home, it's already rented, they're here for the long haul. They signed up for a 2-year lease. They have every opportunity to go out and find any other house right around here and decide maybe there's more value for them to be in it. Not only do they decide that this house, because of all the other features and because how inconsequential this mound is, they decided to rent this home, but they decided to do it for twice as long as every other lease they have to sign, right? Every other lease they sign is a 1-year lease, right? So I think that really speaks more volumes than anything else is that for this resident, they've already made the decision. They're here for a 2-year lease. They weigh this. They say, wow, $1,024 for the quality of renovation that we have in this home is the best value for them. And that's really what your job is, right? A lot of homes, right? They're going to have little things that are not perfect, right? Maybe you don't have a paved driveway, right? Maybe you don't have, I don't know, maybe you can come up with a million different things that nothing's going to be perfect, right? But this is really inconsequential to the overall value. And that's what a resident's going to see.
Okay, so let's talk about this ROI here, right? So now we're just talking specifically about a property and right, like we know what the cash flow represents. Let's talk about this ROI number here. What does this ROI number of 10.09% represent, Greg?
So this is your overall return on investment. What we're looking at is now most of the profit centers, not even all of the profit centers, most of the profit centers. We're taking a complete picture of this, and then we're dividing it by your initial investment. And this is really showing you how hard your money is working for you. All right. So when we're looking at most of the profit centers, what we're talking about is your positive cash flow, also known as net rental income. We're talking about your tax savings on the property. We're talking about your principal pay down on the property. And we take all of those and then we divide it by your initial investment, which is your down payment plus your closing costs. And that's how you get to your 10% return. Should point out though that we also include estimates for your maintenance cost. We also include estimates for your vacancy cost. This all drags down your return on investment, right? We include it in these numbers as you should. We also include the full impact of your tenant placement fees, right? Your tenant placement fees are equal to 1 month's rent. Well, we include the full impact of that in year one. Even though our average resident stays 54 months, you don't get one of those every single year, we include the full impact of that in year one, which keeps these returns even lower, right? They would be a lot higher if we were not as conservative with the way that we present numbers. So you include all of that. You include the additional profit centers like we've talked about. You take it divided by your initial investment. That's how you get 10%. And it leaves out one profit center. Which one have we not included, Pablo?
Well, I appreciate you asking me that because I see here that the appreciation rate is 0% on this analysis. Okay, let's talk through that now, Greg.
There you go. Nice volley right back to me. I like how you did that. So Jacksonville, for any of you who are interested in investing in Jacksonville, you're coming to us, I would imagine, because you know Jacksonville is a growth market. And when I say it's a growth market, that means that historically we appreciate at a higher rate here in Jacksonville than the national average and a lot more than other comparable cash flow markets. Actually doing the research on it, since 1991, Jacksonville has appreciated 34% more than comparable cash flow markets. So we appreciate a lot more. We grow a lot more. The reason why we put 0% there is for a couple of reasons. Number one, if you want to fully evaluate the impact of home price appreciation, you should be doing that with one caveat. You should be doing it with the caveat that you are a buy and hold investor and that you plan to hold on for a full market cycle, because that's the way appreciation works. Over full market cycles, appreciation comes back to the normal historical appreciation rate for that said market. And you can look at 10, 15, 20-year segments of time, and you'll see that through those segments of time, generally it's very close of an appreciation rate to what the long-term historical appreciation rate is. And so you've got to be investing for a full market cycle, which is known to be between how many years, Pablo?
10 to 20 years is what I heard.
10 to 20 years. So it's like you have the answers to the test in a sense, right? You know that if you are in for a full market cycle, that you can count on home price appreciation. But the reason why I don't include it here is because I don't know how long you're going to invest. I can tell you that my thoughts are that you get the best risk-adjusted return on investment by buying and holding for a long time. That's why I still own all of the homes that I bought in 2006. I still own them, and I plan to hold on to them for forever. And so I can count on that. But if you're only investing for 1 year, 2 years, 1 year, 2 year, 3 years, even 5 years, appreciation is then speculative, and I wouldn't count on it. I don't think that that's a smart thing to do. So I don't know how long you're going to do that. And the other thing is, when you start to put this long-term appreciation rate into these calculations from a return on investment perspective, the numbers just jump up, which is great. And I'm sure we'll show that in just a second. This is the full impact of the 5 profit centers.
Done.
There we go. Right, there we go. Jumped up.
Ask and you shall receive.
Gosh, so good. We're just so in sync, right? It's
So,
like we've
so
done
for
this
our,
before.
so for that's right. So for our friend listening on the podcast right now, we put in 4.3% appreciation, and the estimated conventional financing total ROI went to 25.73%. Can you explain to us what happened there?
Absolutely. So this is one of the amazing parts of rental property investing. Something that is often overlooked is how important access to inexpensive leverage is, as far as you making your decision on what asset class is right for you. The access that you have as a rental property investor to inexpensive leverage is unlike anything else you'll see in any other asset class. Real estate gives the best loans, the best terms. You can't go to the stock market and ask to get a loan to go out and buy stocks, generally speaking. So your access to leverage really helps you when you're investing in a growth market, especially, because what happens is, as your asset grows 4.3%, that's the market value of your asset growing. But if you only put 25% down, you can take that growth of 4.3% in terms of your return from the appreciation, your return on investment, you can multiply it times 4, because you only put 25% down. So it's amazing. Over time, we see that real estate does go up if you invest long enough. And at the same time, you have access to this leverage, which just supercharges your returns. And that's why it's taken it roughly from a 10% return to a almost 26% return, because of the impact of investing with financing and the asset growing over time.
Man, that is, I love when you explain that, because that's what, as you know, I'm in the middle of trying to close on my house right now. And that's really what made the most sense to me. It's like this idea of just like, if I'm investing in this asset class versus another long-term safe buy and hold asset, it's like, this is the only one that I can invest in that isn't just my money. It's my money plus some that then gives me interest on like that sum of the whole, right? So like I'm always like baffled by the idea that like you put in a certain amount of money and you're getting return on this whole other piece of the pie as well.
It's amazing, right?
It's incredible, man. It's incredible. We got a great question here from Margaret Smith, and she asks, I know one puts in a maintenance figure for some larger ticket items, such as a roof every 20 years, for example. Do you have replacement time or maintenance figure for septic?
Well, I can tell you that any of those replacements of septic systems has been included in that number that we have there. If you see 9% there for a maintenance rate, that's 9% of the gross rents that we estimate that's what your maintenance cost will be on an annual basis. All right. So any of those, what we call capital expenditures like a roof, right? If you have to replace a septic system, these are bigger ticket items that if you hold houses for as long as I have, you're going to have some eventually. All of those costs are rolled in there. And so I don't know off the top of my head how long septic systems are supposed to last. Maybe we have some septic professionals on the call here and you want to chime in. You probably know more than I do about septic tanks, but I can tell you that we care about how that's going to affect your return on investment. And that's where that 9% figure takes that into account.
All right. And, now that we're talking about it, that 9% maintenance rate, that's a high figure, right, Greg?
Yeah. And this is great to talk about as well. So, a lot of what, maybe investors who are just getting into rental property investing and especially working with turnkey companies, they get really excited about the spreadsheets that look like this because it's a fancy looking spreadsheet, right? You get excited about this one, right, Pablo?
Oh yeah, I'm super excited.
Excited, right? We're all excited, right? The thing about it is what I like to point out to folks is that you have to absolutely know that the numbers on these spreadsheets are real, that they are backed by data. Because, if I wanted to show a return on investment number much higher than this, I could easily do that by lowering expected maintenance cost, or by not including tenant placement fees, or by not including closing costs, right? These are very common things that are done in the turnkey rental property space. And what it does is it gives sometimes unrealistic return expectations to clients. And then what happens is they fall short of those return expectations. And then this client potentially, swears off rental property investing. It's a real shame because it all started with the wrong expectations being set. Now, this 9% figure is higher than what you may hear otherwise. We are so detailed about our data here at JWB that we have been tracking all of our maintenance costs since 2011. We've sold over 2,000 properties since that time, and we track every single month how much did we spend on maintenance across that entire portfolio. And this gives us access to know what your real maintenance cost expectation should be. We break it down to what are the major drivers of maintenance costs. We have seen a significant difference between a property that's on a septic tank versus one that is not on a septic tank, right? And the cool thing is that at the end of the day, I own a lot of homes that have septic tanks, right? To me, as long as I know how much money I need to set aside for a maintenance number and it's factored into my return expectations, and if my return expectations are just in line with everything else, then I'm going to be fine with owning a property with a septic tank. But you got to know what that expectation is. So we've done that. We've seen that over time, the maintenance expectation is 9% of the rents collected each year is the maintenance rate for a home that is on a septic tank. If it's not on a septic tank, it's 6% because that's what the data has showed us. So the simple thing that we do is we factor that into returns. We're basically allowing you to set aside a higher amount for expected maintenance cost and still hit that 10% return number. And if for any reason we had to put that 9% rate in there and the returns weren't this high and they weren't high enough, they didn't meet our 9 to 11% threshold, then we simply couldn't offer this property to you because it just doesn't meet the ultimate return on investment, assuming that you're going to have slightly higher maintenance costs for a septic tank.
I wanted to illustrate that point. I started messing around with the spreadsheet while you were talking because I wanted to illustrate that point of like people juicing the returns, right? So if let's say you're looking at a spreadsheet, it's on a septic tank, but they used the market number for standard maintenance, which is what do people normally put into, like 5 to 6%, something like that?
Yeah, it's gotten a little bit more aggressive. Usually people are putting 5% in now, I'm seeing.
Okay, so let's give people the benefit of the doubt and put it at 6%. Look at how your ROI changes right off the bat, right? It goes up a full 1%. Now you're thinking that, plus let's say that they were to include the appreciation already, not asking you how long you're going to be there for a full market cycle, right? Like not like taking into assumption that, and they're selling you 26%, right? By the way, full disclosure, I learned that this is happening because of our call a couple of weeks ago with Abraham Guerrero that was talking about how he initially invested with somebody else and this is what they were doing, right? So
Yeah.
like, easy way to juice up these numbers that you've been telling me about for a while, but I hadn't really seen the effect of it on the psyche of the purchaser until we had that interview. So we like to show it here on the spreadsheet as well.
Mm-hmm. And the other reason why we care so much about making sure these numbers are real is because there's nowhere to hide from us, right? We have in-house property management. And so if we don't hit these returns, we can't point the finger anywhere else, right? It's on us. A lot of turnkey providers do not have in-house property management. More or less, they basically outsource the property management. And I think that's a real warning sign. If you want to have a real passive investment and accountability. So we have nowhere to hide. And the other thing is that we report on our returns for our clients every single month. Pablo, you're going to start to see this soon once we get your first investment closed, right? It's called your client ROI report. And so we show you, what did Gregg's team tell me? It'll say 10.09% is the expectation for this home on 4th for the client that owns this. Then every single month, where are we? Are we above? Are we below? And so it is that measurement that matters for us. And it's a big part of our service for you, is to make sure that we're there and that we're above it. And if we're not, we're talking about why and how we can get there. So there's no other company that I know of that has a reporting tool like that. And I think a lot of that kind of leads to a little bit more of an aggressive stance on low maintenance costs, which ultimately hurts clients.
And so you said a lot there that I like to delineate, right? Because in my whole, people don't know this, but I don't work for JWB. I'm a service provider for JWB, right? So like I have been learning alongside the rest of all the other Not Your Average Investor Show fans as we've gone through this, but I've also gone to like really start to understand your business model and what differentiates it. You mentioned a couple of things. One, you have over 3,000 data points that you're actually basing your costs and your forecasts and all these other things around, as opposed to the when I used to collect baseball cards, I'd look at the Beckett magazine and look at the price of my baseball cards, and that's what it was. And now it's eBay, right? So now it's like a live price of a baseball card. You guys know the live price based on the data, based on real data points. One. Mm-hmm. Two, you guys are completely vertically integrated, right? This like shell game of like, nah, that's a property maintenance company's thing. That's something I'm really familiar, having come from the construction industry, of when I'm the construction manager and I go tell the plumber, hey man, you messed this thing up. And it's like, no, that's because the framer didn't frame it right. And then they're like, no, that's the painter that wasn't painting correctly. So I had to do it right. Like the inability to point fingers because you are the land acquisition, the general contractor, the property management arm, and the portfolio management piece, I think lends a lot of value there. And, it just shows that you because of that, you take these proactive approaches of purposefully under promising, because you can then over deliver, as opposed to setting yourself up to fail, which other people, like in general, human nature doesn't lean that way, right?
Yeah.
Like,
it's the setup of the model drives behavior for JWB, right? That built-in accountability drives how we have built our team. It's how we've built our systems. It's how we represent what our returns are. It's how we do everything. And that's why I think it's so critical that you do business with a company that is set up in a similar model where everything is vertically integrated. If you want to have an experience where you're not going to be playing the blame game, between property manager, between, real estate agent, between contractor, there's no blame game. There's no way. Right. And that's how we want it. We want that responsibility because that's what fires us up. That's how we get to perform.
You're not the only one that's fired up about it, Gregg. I'm getting a lot of love here in the comments, right? So Christina View writes us, hey, my name is Christina. I've been listening to you guys. Awesome seminar. Just to share with you, I'm closing today at a house on Brait Avenue. Thank you so much for you guys' support. So excited and looking forward to this investment. That's really cool, Christina. I hope to join you soon too.
Wow, Christina, thank you so much for saying that. I can't tell you what that means to me, to Pablo, to our team. Just amazing. I'm so happy for you closing on the first one.
Yeah. And then Margaret Smith has a couple more flattering comments for you, right? She puts, same house, different manipulation of percentages will yield very different forecasts of profits. These guys have thought of everything, included costs, big and small. That's very impressive. Thank you, Mark. And then in the question and answer, she puts, "You've got the maintenance down, Greg." Yes, most don't include it at all. An investor falls short. Wow, you are rocking it.
Oh, well, thank you guys. I mean, this it's awesome. I love our community. You guys are incredible.
Yeah. I love the community here. So, all right. So let's keep going on with tactics, because we got some great questions here. Margaret, before she put all those really nice things, she goes, "And those CapExes are tax deductions / depreciated, right?" So CapEx is capital expenditure, asking for a friend?
Yeah. Yes. Capital expenditures. And sorry, I didn't hear you 100%. Was it asking if you can write those off? Did I hear that right?
It asks if those capital expenditures are tax deductions /
Yes.
depreciation.
Yes. So tax deductions. Yes. That's not depreciation. Depreciation is really what you depreciate the value of the building. Whereas you, like a capital expenditure, you don't typically depreciate. Now, I'm not a CPA, not an attorney, or a CPA or any of those professionals. So maybe there's a little bit more of a nuanced tax thing that I'm not 100% sure of. But the answer to the question is yes, you spend that money on that capital expenditure. That is a write-off that year for you for sure.
All right, cool. All right, so we got a technical question here from Eddie Harris. He's asking, great job. Well, first of all, he says, "Great job as always. Can you conventional refi on a house that was purchased and paid in non-recourse loans?" Signed, Eddie from Hotlanta.
Yeah, great question. So what Eddie's talking about is he's bought a property with non-recourse financing. And Eddie, feel free to chime in if I'm getting any of this wrong, but most likely you purchased that home in a retirement account, which is, when you're buying in a retirement account, that's when you need a special loan product, which is called non-recourse financing. And the question is, can you refinance that product with conventional financing? Unfortunately, Eddie, the answer is no. Because what you're doing is you're taking non-recourse financing, which is in your retirement account. That's generally where it's owned. And then refinancing that into conventional money, which is outside of your retirement account. So now if I'm wrong and you bought it, you use non-recourse financing in your personal name, which technically is possible, then you could refinance that into conventional loans. It's just not very normal for you to do that, because your non-recourse product is not going to have as great of loan terms as if you used a conventional product, which you could use in your personal name. So most of the time, if you've got something owned in your retirement account, you have debt on it, you're not going to be able to refinance that with conventional financing.
There you go. So Sergio has a question here in the chat. Sergio, I think, is your friend that we were talking about this morning on our run, right?
Yeah, exactly.
Yeah, Sergio, your name came up today. So I just found out that you and Sergio went to college together. I went to UF as well, Sergio. We were talking about a common friend of ours, Justin Latour. So Sergio asks, so assuming average home price appreciation, 20% down payment with a 4.5% interest rate, we can assume this home in 10 years will be worth approximately $200,000. Did I do that right?
I go to my good friend, my home price appreciation calculator when I'm asked, so I don't have to do hard math right on the show here. So let's put this in here. So purchase price of $135,000, and we're going to say it's been owned for 10 years, you say, at a 4.3% annual appreciation. That gets
Greg,
me.
let me stop you real quick. Where is this home price calculator? Are you on the internet right now?
I am on the internet right now. Why don't I share my screen and show everybody?
Go for it, dude.
Let's do it. Oh, I can't do that.
I can make that happen for you. Don't worry about that.
You are the master of all things.
Done.
All right, here we go. So I'll show you what I do. This is my nifty little calculator here. So, and I'll show you where I go from the beginning, right? If I'm going to our good friend Google here, I just literally typed in home price appreciation calculator. This is the one I use more often than not. It's this goodcalculators.com. Why did I choose that one? Because it's good. It's good calculators, right?
.com.
.com. You can use any of them. They're all good. You come to this little calculator here. Gives you the opportunity either to figure out what your, and I'll kind of zoom in here for our friends at home. You can figure out either what your appreciation rate is if you set two figures of pricing here. So like this would be if in 10 years, if your value went from $100,000 to $200,000 and you owned it for 10 years, that would be 7.18% appreciation year over year. So what Sergio's asking is, what's my future home value? So you can just use this drop down, and then we're going to set the purchase price at 135, and then the historical home price appreciation rate on average in Jacksonville is 4.3%. Let's say that you held on to it for 10 years and that it appreciated at this rate of 4.3%. And that in that case, it would be worth $205,672.
There you go. Sergio, you nailed it, man. University of Florida education for the win.
Go Gators.
Go Gators. Awesome. Eddie Harris has a follow-up here. Thanks. And only additional if the house has been paid in full, no more mortgage. Can you then refinance conventional loan? So I guess if we're backtracking here, he has a non-recourse loan that he took out, then paid it in full. Then can he use that house for a refinance conventional loan?
Another great question. I like your creativity. The answer is still no. You can't take assets that are owned by you as your retirement account and then use, non-qualified money is what it's called. Money outside of your retirement account, loans outside of your retirement account. You can't do that. You have to keep things very separate there.
Okay. And Greg, can you just kind of talk about how you would purchase, for anybody that's new here, how you would purchase a home in a retirement account? Can you talk about those mechanics?
And a lot of people are not familiar with it, so I'm glad you brought that up. Many people aren't aware. They think that you're just trapped by investing just in the stock market with your retirement accounts, because that's the only thing that's offered to your company 401k plan, I'm sure. And that's just the normal way that people kind of understand investing. It's actually not the case. You can invest in real estate with your retirement accounts. The thing about it is you have to use a custodian that allows you to do it. Now, the big guys, Schwab and E-Trade and all that good stuff, they don't allow you to invest in real estate with your retirement accounts, but that doesn't mean you can't do it. You have to work with a smaller niche custodian that wants to allow you to invest in something that's a little bit more complex for them, right? It's a little bit more risky for them. The big guys don't have to do it. These smaller niche custodians want to do it. They built their business model around being able to offer these types of asset classes to be able to invest with retirement accounts. So they're called self-directed custodians. And if anybody would like a referral, personal referral to the company that I use currently, happy to do that. I use a company called New View Trust currently right now. And so if you want a personal referral, you can just reach out to my team. You can set up a time to speak with us at chatwithjwb.com, or you can just send an email to info@jwbcompanies.com. We'll send you a personal introduction. Happy to do that. If
I can add one more resource there, or you can go back and check out Not Your Average Investor Show episode with Jason DeBono on it, and you can figure out if you like the dude or not.
There you go. Jason is one of the big guys over at New View and a great friend as well. So speak very highly of their company. So that's what you do. You set up a relationship with a self-directed custodian, like a New View Trust. And then New View basically is going to be the custodian that basically directs your investment. So what you do is you'd work with a company like JWB. At the same time, we're referring you over to New View Trust, or you may work with a different self-directed custodian as well. That's okay too. Doesn't have to be New View. At the same time, when you're making your decision on your rental property and which one you're going to invest in, JWB is working hand in hand with a company like a New View. And what's going to happen is at the contract stage, your retirement account is going to be the purchaser of the property. And at the closing stage, the funds are going to be directed by New View to come from your retirement account to actually purchase the home. And then once you own the home and rental income comes in, it's going to come to JWB, and that's going to be directed back to your account with your self-directed custodian. And then when you have a maintenance item that comes up, that is going to come from the account through your self-directed custodian. So the most important thing is that you cannot commingle funds between you as a person and you as a retirement account. It have to be completely separate all the way throughout.
There you go. That was one of the first concepts that I learned while co-hosting this show with you, right? That was like super mind blowing. The idea that you can take money from a 401k, invest in a rental income property, stuff like that. And I remember you kind of telling me this whole like backstory of your dad saying that that was illegal.
Oh yeah. Oh yeah. My whole, everybody you talk to, most people would say, you think you're investing in real estate with your 401k or with your IRA? They're gonna say, oh, I don't think that, there's something fishy about that. Do the research, do your due diligence, but I can tell you I've been doing it for over a decade.
Awesome. Mark Henninger right now in the chat says, I'm doing this right now and about to contact you guys to get a home with my insurance policy. This is a really great and keeps money in your account.
Absolutely. That's
Agreed.
fantastic. Just like you and I were talking about when you were excited about doing this, we actually went in a different direction than investing there. So there are more nuances to talk to. You have to make sure from a reserves perspective that you have the right amount in there. There's a number of other things that we need to talk about before you just go off and start to do this. So I would highly encourage you to speak with my team who has helped clients do this for many, many years before you're ready to pull the trigger. But it is a wonderful way to diversify. I mean, so many people have all of their retirement accounts in the stock market, and we see what happens in the stock market. It goes up, it goes down, it goes up, it goes down. You don't want to be in that spot of a down moment when you are needing it, when you are nearing retirement. And unfortunately, we never know when that's going to happen. You can put it into a more consistent asset class like rental properties, or you can put a portion of it into a more consistent asset class. It doesn't have to be at all, right? It might be a third, it might be 25%. Who knows what the right number is for you, but you don't have to feel like everything has to be in stocks and bonds.
Yeah, and I may have misspoken here. He says he's doing both, but he was talking about, I guess he brought up something called infinite banking concepts. And I'm as the uneducated fellow that I am, I assume that he was just talking about something you were saying. I try to play it cool there, but I don't. So Gregg, when Mark says infinite banking concepts, can you explain that asking for a friend?
To me, I hear different things for infinite banking. So I probably need a little help from Mark to help him get his help on this one. There's a couple different concepts, and I'm not sure exactly which one he's speaking to. So infinite banking can be using a life insurance policy as a way to get capital to be able to invest. And I don't fully understand all the ways around it. So that might be what he's talking about. Or infinite banking can be a strategy where you basically look at an accelerated debt pay down structure, kind of like Abraham Guerrero, what we were talking about. And so how he's using a product basically to help him kind of use a home equity line of credit as a way to either pay down his debt quicker or be able to come up with additional capital to invest. So to me, it has different terminologies. I would imagine it's one of those two. But maybe Mark can kind of help us out there in the chat.
Yeah, and I'm actually telling Mark right now, if you're not in our Facebook group, would love to have you in the Facebook group. If you want to post concepts around infinite banking and have people share, right? Like, I guess this is the time of the call where we talk about our Facebook group. But we have this Facebook group online. Go to jwbfacebookgroup.com. You can join it. We are right now at like 1,800, almost 1,900 people. We want to break 2,000 by the end of the year, right? Like that's something we'd really, really like to do. And we used to call it our secret cool club because it was kind of a secret, but now that we're almost at 2,000, it's really just a cool club. And it's really cool though. But really, I would love to have you all, join us if you're not a part of it. Mark would love to have you in there. He says he's totally happy to help going now. Awesome, Mark. Great. Post about that. And who knows, Mark, maybe you're a future Not Your Average Investor Show guest here. I'd love to talk about this stuff, right?
That sounds great.
Yeah, be part of the community. Okay, so a couple more questions. Gregg, we're coming up on 1:30. Do you need to go out at exactly 1:30? Do we have an extra 5 minutes?
No, we're good to go.
We're good to go. Super. Margaret Smith says, I have partnered personally on an investment in a real estate note with my Roth IRA before. Mm-hmm. If I did that with an actual property, say on a 50% me, 50% my IRA ownership, would a bank be interested in funding the personal portion of that?
This is something I'm going to defer probably to get a little, it's kind of nuanced. My general feeling, Margaret, is the answer would be no. I don't believe that you can get financing for your personal part of your, of the split of the investment. I'm pretty sure about that, but I would reach out, a great, of course, a lender, conventional lender could give you an answer, but I think reaching out to a self-directed custodian that you're working with already would be another great person to reach out to, or a non-recourse lender that you're familiar with would also probably be a good source of information for you on that one.
All right, there you go, Margaret. You gotta ask an expert. Eddie Harris. By the way, Gregg, it's right. Like we get this all the time, right? Like it's refreshing that you don't know the answer to everything, right? Like,
So that's pretty apparent.
and then you admit to it, right? Like, so just so you know, you're coming to the show. Gregg's going to tell you what he knows. He's not going to tell you what he doesn't know, right? Eddie Harris.
The last time I got asked that question on the last show, we were talking about reverse mortgages, and you asked me, well, Gregg, as an expert in this, and I said, well, let me see what Google says about this. All right, guys, I just Googled this, and this is what Google says. So you're gonna find out some really great information from me, and then you're gonna find out some really great information from Google by way of me. So. And I will always disclose which is which.
Yeah, you're not an expert, but you can definitely type stuff into Google for sure.
I tell you what, there's skills to burn, baby.
What can he not do? All right, Eddie Harris says, finally, once you are ready to take funds out of the solo K, what type of tax rate is it based on property value? All right, so I gotta rethink this because lack of punctuation here. So he goes, once you're ready to take out funds out of the solo K, what kind of tax rate do you get? Is it based on property value? You guys are beyond awesome. I really look forward to listening. Thanks, Eddie. I appreciate that.
Awesome. Thank you so much, Eddie. Again, I'm gonna urge you to talk to a CPA when we get into the nitty-gritty details about the tax ramifications of when you're taking money out of a solo 401k. I would really urge you to talk with a CPA. But it should not be based on property values, meaning like your tax rate is not based on the value. The overall taxes you pay will be based on the income and the return that you have earned, and then what you have distributed out. So it's more about what you distribute out at a certain period of time rather than what your overall value of your solo 401k would be.
All right, there you go. Bryant Whelan asks, any good real estate CPA recommendations in market? I would imagine in market means in Jacksonville?
Yeah. I'm happy to refer you to the group that we use. They're called Pivot CPAs. Brian Reyes is the man. He's been our CPA, our head CPA for many, many years right now. And again, if you'd like a personal introduction, send that email to info@JWB Companies and be happy to make a personal introduction for you.
All right. And Lou Carlson says, I use the same concept on bank on yourself. You pay the interest to yourself.
Yeah. Like I said, I'm not an expert in it. I've heard it many, many times. It'd be great to learn a little bit more about it.
Cool. Margaret Smith has a question that I think I know the answer for. Does JWB prepare an annual statement for me to give to my CPA?
Yes. Annual statements. Remember, when you're investing with JWB, this is supposed to be a wonderful experience for you all the way throughout the year. And when it comes to taxes, we're going to make it very simple for you. So our portal is set up so that any of your expenses throughout the year are easily seen and transparent. They're always going to be accessible to you. And at the end of the year, it gets rolled up into a Schedule E, which is that document that you then hand your CPA, and they run off and prepare your taxes for you. So very, very simple.
All right, Gregg, we are well over the hour mark today. I think it's been an awesome show, man. I love these Thursday shows. How about you?
They're special, man. They really are.
Yeah, it really is, right? Like this is really like where we get to, when we have a guest. By the way, I have to scroll all the way back up because I think I got a note here from Ken. Ken, who was our show guest on Tuesday, says, finally came down from my cloud of Tuesday. For Gregg, so this is actually a question. Sorry, Ken, I missed it because it wasn't in the Q&A. See, there you go. I'm not perfect. Not that anybody thought it was. First of all, I just want to say, Ken, you were awesome. It was such a great show. Like the feedback that we've gotten from that show has been extraordinary. So super happy to have you back on here. Super happy that you're part of this community. And anybody that hasn't seen it, check it out in the Facebook group. And if not, it's going to come out in about a week on our YouTube channel. But he says, Gregg, Can you elaborate on JWB's program of giving a home to a disabled veteran? Can your owners contribute to this charity?
Oh, what a great way to end the show and end our week here of being on the Not Your Average Investor show. Ken, thank you so much for giving us that opportunity. Yeah, so we are here to change people's lives at JWB. That is our mission, right? It is not to, the rental properties and the property management is the tool. That's the service that we provide. But we believe that we have a platform and a way to really make a positive impact in the community. And so a few years ago, we started JWB Cares, which is our charitable organization. And when we started JWB Cares, we said, well, we want to have a charity golf tournament. And if we can go out to our network and we can raise sponsorship dollars and our team can be a part of this, and our team can donate as well. And JWB, of course, donates as well. We said we can do something really special. In the first year, we raised about $32,000 for a very special organization called Canines for Warriors. And it was amazing. It was beyond our wildest dreams of what we would do in the first year. The second year, we said, well, how can we do a little bit better? And so we're at this moment where we have become a very large scale builder of homes here in Jacksonville. And we're on the top 10 builders list. So we said, okay, new construction is one of the things we do really well. What if we can go to our same group, our same network and our team, and we can kind of connect the dots of really changing somebody's lives a little bit more. And so we set out with the very audacious goal to build a new construction home for a veteran who had fallen on hard times, and to come together and to donate that home to that veteran. And so we did that 2 years ago was the first one. Rick Smith was the first gentleman that was the recipient of the donation from JWB Cares. Then it was an incredible moment in my life and in our company history. Since then, last year we did the same thing. And so this year, again, we are in the process of building that home for our next veteran who is going to receive that. Normally we give the home away in October, but we're all dealing with COVID. So the charity golf tournament is set for March of next year. The dollars have been raised, the home is being built, and we will be giving that home away to another very deserving veteran. And it is one of the moments, just one of the best moments of the year for our team. So thank you, Ken. It's really important for us.
Very cool, man. Very cool. So again, I feel like we were about to sign off and we lost a bunch of people, but 30 people still stayed with us. So, we do not. So next week, Gregg, what are we talking about? You remember what we're talking about?
Yeah, we thought everybody would really love to see the impact of COVID, right? We've talked a lot about COVID of like, here, what's to come? What should you be prepared for? Well, we're in this special moment right now. We're in December. COVID broke in March, right? We have a great sample size of 6 months of real, actual life data of COVID, right? JWB Property Management manages over 3,600 homes. There have been X number of homes sold. There's been X number of clients that have been impacted for COVID. So the cool thing that Pablo and I are going to do is we're going to talk about, give a refresher of what we said our thoughts on COVID were in March when it broke, when there was no game plan or rule book for how COVID was going to be affected. We're going to compare, what did we say was going to happen? What did we recommend to you to make the best investment decisions to do? What were our thoughts there? Then we've got this 6-month case study now that we've got real numbers, and we're going to look at it and say, what are the real numbers, right? How did this compare to years in the past? What's the real COVID impact? How does that compare with what we said? And then we're going to leave you guys with thoughts on what's to come, right? COVID obviously is still dominating the headlines. It's not going anywhere anytime soon as far as just the impact to real life. So what does that mean for future investment decisions? So it's going to be a very cool, we'll call it a 2020 year in review, but it's going to be dominated by what's dominated all of our lives in 2020, which is really the COVID impact to rental property investing here in Jacksonville.
Yeah, man. Again, under the in the whole like under promise over deliver thing, right? Like you gotta give it to you, man. You nailed it when COVID was breaking out, right? Like your predictions of how it was going to affect the market. Even though I remember early on in the shows when we really didn't believe in COVID, right? Like we
yeah.
True story.
Don't look at the January. January, I'm sure I'm on camera saying, I don't see much of an impact from COVID, but I'll take solace in the fact that this many people saw this impact in the entire country coming. So beyond that, we'll give myself a little pass there.
Yeah. Beyond the one time that we made this like one COVID joke about how nobody's ever going to get it kind of thing. Yeah. Once it really broke out and everybody was freaking out about home prices, you were really, really on point as far as like what was happening out there. You were nervous about sharing it live. And I'm like, Gregg, just go for it, dude. Like just give your usual caveats, give your, like temper expectations and whatnot. But tell people what you're thinking so that they know what's going on. And to your credit, you did it. And to your credit, we now have a bunch of content that shows Gregg the Nostradamus of housing prices because your like your stats and the fundamentals of what you were basing it on all came true, right? So like I think it worked out nicely. But I'm not just saying that to flatter you. I'm saying it to say that at this point, you either believe that COVID is kind of behind us, or you believe that maybe there's going to be a second wave, right? So I think it is going to be a valuable bit of insight to understand how you made your decisions, what you were doing, how JWB fared through it, what there is to learn from that moment going forward if we're going back into a second dip, man. So I'm really, really excited to get into this. So that's on Tuesday. Margaret, that's on Tuesday. At 12:30. Next Thursday, we're going to do another property income of the week, right? Rental income property of the week.
Week.
We're going to do another one, but we hope to have you all on Tuesday. Join us again. If this is your first time and you want to download, specifically if you want to download this sheet that we were just messing around with and fiddling with, go to jwbwebclass.com, catch the webinar. That's like a real breakdown of like the whole asset class for you to think about. Mark, we'd love to get your, you being an investing expert, we'd love to get your feedback on that webinar if you want to spend time with us and get the investor toolkit and let us know what you think about that one or anybody else. And again, if you want to hop on a call with the team, go to chatwithjwb.com. If you like this property, right? Gregg, is this property available?
This one was sold. This one was just sold. But the great thing, like all of the properties of the week that I bring to you, if this makes sense to you, there are literally dozens behind it that are very similar. So if this is something that you're interested in, that we do the same thing over and over again, the same types of homes, the same types of neighborhoods. If it ain't broke, don't fix it. So that's what we do. So reach out to my team. You can go to chatwithjwb.com and kick off that conversation, and we'll be able to fill your portfolio with something just like this.
Dunzo, man. All that's left to do is to thank everybody. It is never lost on me that, we had about 40 people today, that you take a full hour of your day to hang out with us in the middle of a work day. It is absolutely spectacular. And it, like unbelievable. And I'm just grateful to be a part of it. Thanks to the great value that Gregg and his team put out, man. So Gregg, I'll let you give the last word.
Pablo, thank you to you, brother. As always, another great show, man. I love the energy that you brought. This might've been the most energetic show for you, right? Coming out of the gates and all the way through. So always want to give you credit for being such an important part of the show, man. And thank you to everybody who joined us as well. I hope you all have a great rest of the week, and we'll catch you next Tuesday.
See ya.